A lot of people want to escape the United States right now, but there's a dirty little tax secret that even CPAs get wrong. Today, I'm going to tell you the truth about what it really costs to leave the United States. Someone recently shared with me a video from a well-known CPA giving inaccurate tax information that in some cases hasn't been true for more than 15 years. The truth is, international tax for Americans is complicated. Now, one of the things that this CPA did get correct that a lot of people who are looking to move overseas will quickly find out is that if you are a US citizen, you're subject to something called citizenship-based taxation. It was not introduced by Obama. It's been around since the 1800s. And it says that if you hold a US passport, regardless of what other dual citizenship you may have, you are required to file a tax return. You're required to report your foreign bank accounts and brokerage accounts to the United States. All the financial rules and regulations and tax rules have to be followed, even if you don't spend a single day in the United States, just by virtue of you being a US citizen. And the only way to escape that obligation entirely is to renounce your US citizenship. Moving to Puerto Rico for their tax savings, which I'll cover in a moment, doesn't remove you from that. There's nothing else you can do if you don't want to have to involve the IRS and the US Treasury in your affairs while you live overseas, then say, I no longer want to be an American. That's why we help people, including in the United States, get second passports, because they realize either now or potentially at some point in the future, they may find it to be much better living overseas. Not only financially, but all aspects of their life. And why do I want this business partner that I have to involve? Now, before I talk about this dirty little secret that I see people in the comments section and even real CPAs getting wrong, let's talk about taxation of US citizens living abroad. Because just because you are taxed on the basis of your citizenship doesn't mean that you pay full US tax rates when living overseas. For example, this from our Nomad Capitalist R&D team, US citizens living outside of the US can qualify for the foreign earned income exclusion. It's a low six-figure amount that you can exempt, whether it's from a salary, whether it's from a business, whether it's from your own business. You can take that right off the top. US citizens who set up foreign corporations while living overseas may be able to defer, potentially indefinitely, large amounts of tax. Most people these days, to put it quite simply, who are American, who are the typical Americans, can move overseas and expect to pay a tax rate in the high single digits. Americans who have become very internationalized, for example, you have a foreign spouse, there may be solutions to reduce your tax rates to as low as zero as an American and potentially defer those taxes indefinitely. Now, there are certain things that our R&D team wanted me to tell you about CFC, Controlled Foreign Corporation rules, and PFIX that you want to keep in mind with your business. The first probably applies to more people than the second. But the bottom line is Americans can move overseas, take advantage of the foreign earned income exclusion, be outside of the United States for the majority of the year, and you can dramatically reduce your taxes. Here's one misleading piece of information that I see many CPAs in the media often talk about, and that is that you can take advantage as a US citizen who does owe those taxes overseas. Yes, you get the exclusions and the exemptions, but you still owe. Hey, don't fret. You can take advantage of foreign tax treaties with the US, or you can take advantage of foreign tax credits. And so whatever you pay somewhere else offsets what you owe in the United States. But here's what I know. We've helped our clients move to over 30 different tax-friendly countries. Some are zero tax, some are very low tax, some in Europe could be a lump sum, where in Italy you pay 200,000 euros. If you make 5 million euros a year, that's a 4% tax rate. And so the goal shouldn't be that you have to move to an equally bad country from a tax perspective in order to not pay the US. That's not fair. If you want to move to France, you're probably not going to owe the US much, if anything, after you're done paying France with their insanely high taxes. We don't generally help our clients move to France. Even our clients who are more liberal socially, who perhaps don't want to live in Donald Trump's United States, they can find places in Western Europe that have not zero taxes, but reasonable taxes. They have multi-year tax exemptions, tax reduction, lump sum, flat tax, non-dom regimes. And so if you're not going to pay the full freight, even in Western Europe, that you'd pay in the United States, there may be some cases when that works out. But the bottom line is, why should you have to go somewhere else and pay 40 or 45% at the top just to get out of the worst parts of citizenship-based taxation. A lot of our clients want to move to Costa Rica or Georgia or Malaysia or Singapore or Panama. Those countries may not tax them at all on their foreign income. And again, I mean, countries even like Ireland and Western Europe, you might pay a very low tax burden as a foreigner. And so this idea that, oh, you'll just get a credit isn't necessarily applicable. You deserve to choose from the full breadth of places where you can potentially move. Again, 30 plus different tax-friendly countries that our clients have moved to. That's a lot of different options. It's not like, well, there's only Dubai and I don't want to live in the Middle East. There's places in all corners of the world where you can pay rather low taxes. The truth is, if you're an American living overseas, yes, you need comprehensive tax advice. We have a network of experts around the world. If you go to nomadcapitalist.com/apply, what we do is put the pieces of the puzzle together so that the guy in the US talks to the guy where your company is based, talks to the guy where you live, and it all has to work out and it all has to be legal. That's what's required with being an American. Now, they went on to talk about, hey, some Americans moved to Puerto Rico. There's some misinformation here. This is a CPA who does mostly domestic tax work, talking about international work. What have I told you for years? International tax planning, especially in the United States, is a very niche thing. There aren't that many people who are experts in it, and we've seen time after time after time for years with our clients. People come, they talk to a domestic CPA, or maybe the CPA does, the US and Canada. And we see mistakes made all the time. We see bad advice given, generally advice that tells you, no, you can't do that, when you actually can do that from CPAs who are playing it too safe. But in this case, they're talking about how you can move to Puerto Rico and reduce your income tax rate from the top federal bracket of 37% to just 4%. Now, again, from the Nomad Capitalist R&D team, this is slightly misleading because while there is a 4% income tax rate in Puerto Rico under Act 60, that rate is for companies, i.e. a C corporation, not individuals. So yes, you can lower your corporate tax rate down to 4%. Theoretically, you could say, well, that's only from 21%, the C corp rate in the US, down to 4%. But theoretically, you might choose, if the C corp or equivalent rate is 4%, to run your business through a C corp type structure rather than, let's say, an LLC. So you could still argue, hey, I'm going from some of the top income rates down to 4%. But that 4% corporate income tax rate applies to companies that export services from Puerto Rico. Not every business applies for that. What the CPA also failed to explain is that bona fide residents of Puerto Rico can, at the individual level, legally avoid U.S. federal taxation on Puerto Rican source income only. So if you have investments outside of the United States, which we often talk about and think is a good asset diversification strategy, Puerto Rico is generally not going to help you with that. So any interest, dividends, and capital gains that you earn from Puerto Rican sources are indeed taxed as low as 0% under Act 60 in Puerto Rico. However, those non-Puerto Rican income and dividends and capital gains will be taxed according to U.S. federal income tax. And in the case of your capital gains, if you move to Puerto Rico, what the CPA omitted was that any appreciation that you accumulated, let's say a capital gain, while you were in the United States, prior to moving to Puerto Rico, it's still subject to U.S. federal tax. There's a couple different tests that you want to be aware of there, but you can't just move to Puerto Rico tomorrow, sell your company the day after and say, hey, this company I spent building 10 years, or this Bitcoin I've been hodling for the last 10 years, hey, you can't tax it, give me the 0% rate. It doesn't work like that. It works from when you move in. What do I tell you? The sooner you move overseas, perhaps if you qualify, the sooner you move to Puerto Rico, the sooner you get the savings. You can't plan backwards. Don't call Nomad Capitalist once you already have a big tax bill and say, how do I wriggle out of this? You got to plan in advance. And so they oversimplified that, as well as there's multiple tests to make sure you even qualify for Puerto Rico's tax incentives. Do you meet the physical presence test? Do you not have a tax home outside of Puerto Rico? And do you not have a closer connection to the United States or any foreign country than you do to Puerto Rico? So Americans, right, they can live overseas. That's the main thing we help people do. And you can dramatically lower your taxes. But some people are going to live overseas long enough and say, I don't want to be a U.S. citizen anymore. Some people think Puerto Rico is better, but they don't realize all what's involved. And a lot of CPAs oversimplify. They make it seem easy. I'm guessing there's people who are probably going to these types of CPAs, going down to Puerto Rico, not following the rules correctly, and thinking they're getting away with something. And that's why they don't call Nomad Capitalist, because we are the goody two-shoes of the offshore business. I'm going to tell you, you have to be in Puerto Rico, and that has to be the center of your life. So that brings me to this 15-plus-year-old dirty little secret that I keep hearing, and I, quite frankly, am shocked that I'm hearing from an actual CPA. What happens when you say, I don't want to live in Puerto Rico? I could have lived in Puerto Rico. I didn't want to. From a lifestyle perspective, I'd rather not be a U.S. citizen, live wherever I want, spend my time with whomever I want who may not be able to come to the United States, than keep the U.S. citizenship and live in a place I don't want. That to me shows it's not all about taxes. It's about lifestyle. I could have had low taxes in Puerto Rico. I could have had low taxes not giving up the citizenship. And so if you make a decision, I no longer want to be a U.S. citizen, there's 3 ways to trigger the exit tax. You have a net worth of over $2 million, not just on your U.S. assets, but on all your assets anywhere in the world. Do you have high federal income tax payments you've made totaled up over the last 5 years? Or are your taxes not in compliance, even filed, for example? If you trigger any of those tests, you owe an exit tax. It is a deemed disposition where they assume all of your assets are sold. If you have no capital gains, then there is no tax. You can trigger the exit tax, but owe nothing. So let's say you sold your company for $100 million. You paid all the US tax on that, and you put the money in a savings account somewhere. It's earned nothing since then. There would be no deemed disposition to be had because you don't have any untaxed capital gains. The exit tax is the US government's final bite at the apple. But here's the mistake that I keep hearing being made. And that is, even once you pay the exit tax, you have to keep paying the United States for the last 10 years. Here's the facts. Here's where this 10-year, let's call it a look back, does come into play. There were 2 different periods. One from 2004 to 2008 during the George W. Bush years, and a different one before that. But basically since 2008, the 10-year look back has not applied. Up until then, there were times when, if you renounced your U.S. citizenship, the government, the U.S. government would expect you to file and pay on your worldwide income, same as if you were a citizen, for any of the 10 years following expatriation in which, and I don't hear these criteria mentioned, you were physically present in the United States for 30 days in that year or 60 days in the case of individuals working in the U.S. for an unrelated employer. And so basically, it was you renounce, and we're going to keep taxing you for 10 years if you spend a little bit of time here. So 30 days is close enough to the foreign earned income exclusions more flexible test for people like me who didn't want to be in the US. You can spend about 5 weeks in the US versus this gave you 30 days. I'm not saying they're related, but just kind of a similar amount of time, right? So if you're me and you've been keeping your time to a couple weeks in the US per year, then potentially you could keep your time after expatriation under 30 days. If you have work you have to do, it could be under 60. For people like myself, I gave up citizenship not intending to go back. And I've talked in other episodes why I will never return. I think people, they think like, oh, he'll return for a visit. No. I currently have no plans to ever return for even a minute. Now that's perhaps an extreme position, but it shows that there are people like me out there who don't need the US as part of the mix in their life. The other issue is what passport or passports are you using to give up US citizenship? There are some folks out there who just choose to be, Dominican. They expatriate as Dominicans, and depending on where they live, they may have a harder time getting a U.S. tourist visa. There's only about 42 countries in the world that participate in the U.S. visa waiver program, where you could just show up with a completed ESTA, kind of pre-clearance form. Everybody else has to go and get a visa. And so if you're a nomadic guy traveling around the world as a Dominican citizen, you can do that. The odds are less that the United States will give you the visa to come back. So some people won't even have the opportunity to spend 30 days in the United States after expatriating. But the bottom line is that rule has been gone for over 16 years now. And yet it's this zombie comment that I keep hearing people talk about. Oh, they're gonna track you for 10 years. You better watch out. Let's set the record straight. Americans can move overseas, particularly if you're an entrepreneur, you can dramatically lower your taxes. Depending on what your family structure is, depending on who your business partners are, depending on a number of other factors, you can reduce your taxes to somewhere between 0 and, let's call it 10% for most people. Because you get a foreign earned income exclusion, you've got to deal with things called GILTI, lots of different things going on. But that's what your tax rate's going to be for most entrepreneurs if you run a business that qualifies to move overseas. There's certain conditions around that, by the way. Your business generally can't just be you. You need an actual business, not a profession. So there's lots of rules surrounding U.S. tax. And I think that's why these zombie lies kind of come back into circulation. But the bottom line is, yes, you can move overseas, you can lower your taxes. You can move to Puerto Rico, but it's not as easy as even many CPAs make it sound. And if you want to expatriate, you can do that. There may be an exit tax on any unrealized capital gains. That is the one unrealized capital gains tax that, even with Kamala not in the White House coming up, you do have is when you expatriate. But they don't follow you for 10 years. You pay once, you file your Form 8854, and off you go. And from my perspective, there's a lot of things to consider. There's a lot of things you want to get correct, particularly if you have a business. You want to make sure that's valued correctly. But you ride off into the sunset. They are out of your life. Now, if you choose to go back and spend time in the United States, you could get sucked back into the tax net. So don't think I just give up my citizenship and I go and live in the United States. And now people have made jokes about, oh, well, with Biden in power, just come across the Mexican border as an illegal immigrant. Well, yeah, if you're spending all your time in the United States, I don't care what citizenship you are going to be taxed as a U.S. person. And so it's not just as simple as give up the citizenship and then find some way to get back in. You'll be taxed for being there. You might as well keep the citizenship. But we wanted to set straight once and for all, there is no 10-year look back. You can be out, you can move on with your life. And so I think for a small number of Americans who realize they will be happy for sure living overseas, expatriation is something you can do, living on another country's passport or passports. And for me, I've never looked back. I think if you realize you don't have to look back for 10 years, maybe it's something that comes back onto your radar as an option.